Good morning and welcome to Tuesday's edition of Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vivek Iyer, and the morning strength is fading now, and it's fading quite rapidly. We opened up higher. There was a gap up opening, the Nifty gaining for the 7th day in a row. We also surpassed our February high, which was about 23,800. We went on to hit levels of 23,867. But from that level, in the last 1 hour, we've seen the markets come off, and it's now nearly 200 points off from the session highs, hovering somewhere around the 23,700 mark. IT is holding fort for the second day in a row. The Nifty IT index is still strong. And remember, the Nifty IT index is still an underperformer. So year to date, while the Nifty is turned positive, the Nifty IT index is down about 12 to 13%. So it still has some catch up to play. Yesterday, it was CLSA. Today, it's UBS. And they're all saying that perhaps the pessimism, the correction could be overdone. But the problem is the broader markets, right? I think some fatigue, tiredness after the recent run-up.
Good morning, Reema. Like you mentioned, volatile trading session. So the mid-caps and small-caps, 6-day winning streak is what they are snapping today. Both of the indices in the negative territory. Advanced decline ratio in the broader end of the markets skewed towards the declines. One stock that stands out amongst the banking pack is HDFC Bank. That stock is seen, or that bank is seen as the key beneficiary of RBI's move to go ahead and enhance the loan limits across various categories under the PSL. The other set of stocks that are in focus, and Vinny just highlighted them a while ago, Syngene as well as Pyramid Pharma, both of these stocks are doing quite well. Kotak Institutional Equities initiated coverage on both of these stocks, and both of these stocks are doing quite well. A couple of stocks that are under, in focus on the back of QIPs is Restaurants Brand Asia, Central Bank of India, as well as Punjab and Sind Bank. All three of them actually seeing divergent trends. But Reema, a couple of stocks that you're tracking as well.
Indeed, some news coming in on RailTel. It seems to be positive because the dispute with respect to the telecom department is now withdrawn, has been resolved. The telecom department has withdrawn its demand of 1,500 crore rupees with respect to non-telecom revenue. The DOT had demanded it from RailTel, but now they've withdrawn that demand, so that dispute has been resolved. So some relief coming through for RailTel, and it's trying to trim some of its losses. But let's talk about IT. That's clearly the sector of the day, and it's UBS today, which is talking about more upside in the stocks compared to downside. So they're saying that Indian IT stocks have corrected 15 to 20%. The earnings downgrade in the same period was not much, about 0 to 2%. So what happened is the PE got corrected to a much greater extent. In some cases, it was nearly about a 20% correction in the PE. Now, they spoke to IT companies, and their discussions with the management suggest that, yes, uncertainty has increased, but it's not that there has been a big impact on client spending. If at all, very marginal. So they do expect that FY26 is going to be a tough year. There will be earnings cuts of about 5 to 7%. But that said, FY26 on the whole will still be a better year compared to FY25. And therefore, there is scope for the earnings, PE multiples, which contracted over the last 3 months, to get back to the levels that it was prior to that. And what will help offset some of the uncertainty or the US economic slowdown is corporate tax, Fed rate cuts. So these are some counterbalancing forces. So just putting on board what UBS expects IT companies to do, at least large cap IT companies to do in FY26. Except TCS, all the companies will do better or post a higher revenue growth compared to FY25. Now talking about the valuations, because their call is that the valuation derating seen in Indian IT companies was excessive, and we will see some reversal in that, some recovery in the valuations. So they're saying TCS is trading at more than one standard deviation below the 5-year average. Infy is trading below its 5-year average by about 0.6 standard deviation. And all the whole, the Nifty IT is also trading below its 5-year average. So therefore, they expect valuations to revert, and they are bullish on TCS, Infosys, Wipro, HCL Tech in the large cap, sell call on Tech Mahindra.
Thank you so much, Reema, for telling us about what exactly is the call as far as Indian IT is concerned. The IT index amongst the top gainers today with a gain of over 1%. But a very interesting note from UBS today on the entire cement pack. Nigel joins in with more details.
Well, that's right. UBS has upgraded the cement sector as they believe that the rough patch is coming to an end. And so they're upgrading UltraTech, Ambuja's Dalmia, to buy. Remember, UBS, they had a negative view on the sector itself all the way since July 2023 because of rising competition, demand slowdown because of the general elections, and also rising price competition after Adani's entry into the cement space. But now, UBS, they've turned positive. They anticipate earnings upcycle to emerge from the coming fiscal year. and they're expecting strong EBITDA growth for the next 2 fiscals. Their positive stance is backed by demand revival, which will be driven by the housing upcycle, as well as revival in government capex. The structural cost savings, that's what's going to help margins. And also, they believe that pricing is likely to bottom out after the weak pricing we've seen in the first 9 months of this fiscal. They also highlight that the sector consolidation led by the top 2 players, that is UltraTech as well as Ambuja. Reasons for upgrading the stocks, and the chart should come up for you on the screen. UltraTech, they say that they have shown strong execution in tough times with industry-leading growth as well as on margins. Their top pick, though, is Ambuja due to the high growth and lower valuation. While on Dalmia, they have done a U-turn. They have upgraded it from a sell to around a buy. And also, they continue to remain their positive stance or the buy rating that they had on ACC because of supportive valuations and industry tailwinds. Put all this together, UBS, after being underweight or negative on the sector for the last couple of years, they have turned positive on the cement pack, and that's what's playing out on the stock prices. Back to you.
Thank you. So UBS constructive on IT and now cement too. But let's talk about the other big issue. SEBI has decided on a host of changes in its board meeting held yesterday. Yash is joining in with the key details. Yash.
Well, it was the first board meeting under the new chairman, Tuhin Kanta Pandey. It was a long list of agenda, and what came out again was a long list of changes which have been suggested by SEBI. First, good news for smaller foreign portfolio investors. Market regulator SEBI going ahead and raising the threshold when it comes to FPIs which have to submit additional or granular disclosures with SEBI. Now the threshold for submitting that additional disclosure would be 50,000 crore in equity AUM in the Indian equity markets as compared to 25,000 crore rupees. What doesn't change here, essentially, any FPI having 50% of its total equity AUM in a single corporate entity will have to continue to make those additional disclosures. Apart from that, when it comes to public interest directors moving from one MII or market infrastructure institution to another one, this will continue to require SEBI approval but won't require shareholder approval. Also, now the cooling off period between the PID or the public interest director moving from one MII to the other one, now that cooling off period will be decided by exchanges and not SEBI. Another good news which came in for all the investment advisors and research analysts. Now these research analysts and investment advisors will be allowed to charge an advance fee to their clients to up to 1 year, which is 4 quarters. Currently, investment advisors can only charge advance fee for just 2 quarters. Research analysts can charge this advance fee just for about 1 quarter. Finally, SEBI's announced formation of a high-level committee. What this committee will do is it will decide what needs to be disclosed by its own board members, what is the conflict of interest which needs to be disclosed in terms of assets, investments, liabilities, all of those things. And this committee will submit its reports in terms of those regulations within 3 months after it has been formed. Interestingly, during the question and answer session with SEBI chairperson, there was also a question which was asked on NSE's potential IPO, and that got some interesting response from the chairperson. Hear out what the SEBI chairperson had to say as far as NSE's potential IPO is concerned.
But surely, I think we'll look into it. I've just, we'll apply our mind on how is it and how we can take it forward and what's the issues.
In fact, to discuss this in greater detail, the key takeaways from SEBI's board meet, we will have Sunil Badla, who is the national head at KPMG, and Tejas Desai, partner and leader of Wealth Asset Management Tax at EY India, joining us today at 12 noon. So stay tuned for that conversation. We'll get into a break on that note. We'll come back and discuss commodities on the other side with Manisha Gupta.
Welcome back to Trading Hour. Well, let's now shift focus to the commodity space. Manisha joins in, and today she's focusing on crude.
Well, the crude oil prices have seen a percentage point of gain in the overnight markets, trading around $73 a barrel for the Brent prices. And with that, it's a 3-week highs coming in for the crude oil prices. Having said that, the first quarter clearly seems to be going into the negative. We are down by nearly 2.5% for both the crude varieties at this point in time. But currently, it is all about Trump announcing a 25% tariff on any country buying oil from Venezuela. Now, China is the largest buyer of the Venezuelan oil, and how will that impact shippers, insurance companies, and China itself in sense of the largest importer is something that the markets are weaving in sense of premium in case of prices. The second thing to watch out for is the OPEC and allies meeting, who have been talking about increasing production from the month of May. April 5 is when the OPEC and allies meet, and any statement coming in from there will have a direct impact on the crude oil prices. The third thing is more importantly about on how OPEC and allies really have been cutting output. Remember, 40% of the global crude production comes in from OPEC. They have been cutting to the tune of 5.8 million barrels per day since 2022 and have been looking to bring back this crude production back into the markets. Most of the analysts believe that the crude prices, the sudden surge that we have seen, is very event related. Going forward, it really is between 65 to 75 that you will see the crude oil prices trading for the rest of 2025.
Manisha, thank you very much for that important update. Some stocks which have moved lower. So Tata Consumer is one of them. Titan continues to struggle. Yesterday, it was down close to about 2.5%. It's followed it up with another 0.5% loss. And Indian IT names, the Nifty IT index itself is up closer to 1.5%. And now it's trimmed some of those gains. So up nearly just about 0.5%. So come off from the day's high. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar joins in with his top trading bets. Welcome back. Let's focus now on the CRDMO sector. Kotak has issued a note. They've initiated coverage on some stocks. Vinny is here to tell us more. Vinny.
Yes, Kotak has issued and initiated coverage on some of the CRDMO space. CRDMO is Contract Research Development Manufacturing Organization. So they are third-party manufacturers somewhat of that sort to make it easy for pharma companies. Now they've initiated coverage on PPL Pharma, buy rating, target price of 300 rupees per share. Syngene is another one, buy rating, target price of 700 rupees per share. And Sai Lives, they've initiated coverage, reduced rating as of now, and target price of 875 rupees per share. What they say and what factors they believe will work out well for these companies: one, the rising focus in terms of the research and development outsourcing that may continue to inch up going forward as well. In 2005, it was somewhere around 18%, and now it's become 42% across the globe. So that is an increase coming in. Plus, we have seen that shift coming in where everyone wants to reduce their focus on China and come to other countries, and that is what is something that could work out well for Indian CRDMO companies as well. So that rising shift from China will augur well for these Indian companies. Other than that, they expect the CRDMO market to even quadruple over the next decade. So that is important to watch out for in terms of the growth opportunity that they see coming in for these companies. And that is why they have come out with a note on this. Most of them are a positive rating that they've given here.
Thank you so much, Vinny, for joining us and talking to us about Kotak Institutional Equities report as far as the CRDMO space is concerned. But moving on, brokerage firm Macquarie has written a note indicating its preference for restaurant companies over food delivery aggregators. Manglam joins in to tell us more.
Well, you know, the underlying thesis is that food delivery or food consumption is likely to continue to grow. Where do you allocate your money in this space itself? Do you go via the QSR way or do you go via the food aggregator way? You know, over the last many quarters, investors were betting on the food aggregator way, and as a result of which we saw underperformance of the quick service restaurant space. And at the same time, we also didn't see much business growth coming in for quick service restaurants until the last quarter, where we saw 4 or 5 straight quarters of declining trend when it came to gross order values in these food aggregators. And at the same time, there was an increase in the same store sales growth or like-for-like growth that we saw in a lot of these quick service restaurants as well. So taking note of that, Macquarie has written, they've said that, you know, the increased money that all, consumers will have on account of the reduced taxes that were announced in the budget will go towards restaurants as against food aggregators, because food aggregators are now at a space where gross order values are stable, operating metrics are by and large stable, and will be led only by increasing users as against, further expansion that they would see out there. The unit economics are only stable. Add to that the uncertainty around the quick commerce foray for all these guys keeps them cautious on food aggregators like Swiggy as well as Zomato. They do believe that maybe the next leg of consumption in food would be led by quick service restaurants, and as a result of which, on account of valuation preference, they choose Devyani and Westlife. But we are seeing a resurgence in the stock prices of a lot of these food, quick service restaurants, and decline in the prices of food aggregators.
Thank you very much for that. Let's move on now. Ola Electric also opened higher after it settled all dues with the Rosmerta Group. Sudarshan gets us the details and the backstory behind this. Sudarshan.
So there is a positive development in the case related to Ola Electric and Rosmerta Group. If you remember last week, there was a news that Rosmerta Group had moved NCLT Bengaluru, filing the plea alleging default against Ola Electric. Now, early morning today, Ola Electric disclosed to exchanges that it had resolved all the disputes with Rosmerta Group, and now Rosmerta Group has agreed to withdraw its plea against Ola Electric. And following Ola Electric's disclosure, even Rosmerta Group has released a statement saying yes, the disputes between both the companies have been resolved, and also it has received the amount of nearly rupees 27 crore from Ola Electric, and going forward, relationship between both the companies will be based on the agreement signed. So now overall it's positive because Rosmerta Group is the agency who does the registration work for Ola Electric vehicles that are being sold. So overall it's positive, but stock had opened higher, but now it's in the red.
Thank you so much, Sudarshan, for joining us and telling us about the news flow related to Ola Electric. But moving on, technical analyst Mitesh Thakkar now joins in for a quick technical check on the market. Thank you so much for joining us, Mitesh. Some exhaustion seen at high levels. Do you feel markets will head further downwards from here, or do you feel that the bulls are just taking a breather?
My understanding is that this could be a pause. We've had a very good rally, and the markets has continued to move up, and the setup is also turned positive. But just look at the extent of the rally. The Bank Nifty has already gone up by nearly 4,000 points in the last 8-9 days. Similarly, the Nifty, if you talk about it, has done from 22,200, 300 zones to about 23,800, so 1,500 points. And now I think they are very overbought on the hourly chart. So it's a welcome pullback. In fact, I've been talking about this, that if somebody wants to go long now on the indices, be tactical, be slow, trade with tight stop losses, but wait for a dip to come in. I think that will be a good entry point. My preferred entry level on the Nifty is around 23,600, give and take 20-30 points here and there. And on the Bank Nifty would be closer to about 51,500, 450 zone. So, I think a bit more decline, and I would be an aggressive buyer on the indices.
What about stocks, Mitesh? Is there anything that one can buy at these levels?
I like a couple of cement names. Ambuja Cement is a buy for me. Keep a stop at about 524 and look for a target of 560 here. Similarly, ACC is something which I like a lot, but I'm just waiting for the stock to clear a weekly pivot. Once it starts trading above levels of 1960, 1965, and today we had an intraday high of 1967, but I would want a closing about that. So buy about 1960. Keep a stop at 1930, and then the stock could possibly head towards 2040.
Thank you so much, Mitesh, for joining us, giving us your views on the market as well as your individual trading calls. We'll take a short break now. Up next, we'll discuss more on the markets and stock-specific action. Welcome back to Trading Hour. Well, the market has slipped further. The Nifty Small Cap Index now down over 1%. But moving on, the RBI has modified priority sector loan rules. How will it impact banks? Lata is here with more details.
Well, first things first, priority sector is that 40% of all the loans banks have to give some favored sectors like, farming, affordable housing, renewables, etc. Now, regularly the Reserve Bank does modify these rules because they have to at least adjust for inflation, sometimes even for new products like renewable products. So what is the revision now? Houses, the limit has been raised as to what will qualify as priority. For big cities, over 50 lakh population, They used to give only up to 35 lakh loan as priority. Now it can go to 50 lakh. For smaller, for smaller towns, mid towns, the level goes from 35 to 45. And for, very small towns, the limit used to be 25 lakh to qualify as priority. It goes to 35. Then there are other limits that have been raised. You give even for damaged housing repair. Even there, similarly, for various categories, the limits are raised. Education loans, only 20 lakh was considered priority. Now it's become 25 lakh. So loans for, drinking water in schools, sanitation, that has been up from 5 to 8 crore. Healthcare in tier 2 and lower cities, smaller cities, has been up from 10 to 12 crore. And the number of people who qualify as weaker section, it has been increased a little, artisans, cottage industries and women, and also the amount that you can give them to qualify has gone up from 1 lakh to 2 lakh. So basically, they're adjusting to inflation and they're adjusting to a few new products. Then there are smaller, ease of doing business for banks, if you please. There used to be an interest cap if banks sold off the loans in the form of securitization. Those caps are gone. For urban cooperative banks, there is a genuine big relief. They had to give 75% of their loans as priority loans. Now they have to give 60%. And then for renewable energy, more projects under renewable energy are included as priority. These are also technological advancements which bring new products into the market. Now, who benefits? Well, all banks benefit in a way because it's easier to find a priority sector borrower. If it is a very small amount, it becomes more difficult for them. And HDFC Bank benefits because, they had this huge HDFC loan coming in and they had to do priority sector for that entire lot of some 7 lakh crore. Now more of the erstwhile HDFC loans will qualify as priority sector because the limits have been raised. And likewise, other banks, this is an IIFL note, which says banks like RBL, SBI, IIB, Federal, used to now and then fall short. In 2024, they fall short of that 40%. Then there are ways you buy priority sector certificates from other banks, or you have to invest in what you call RIDF, Rural Infrastructure Development Fund, done by the NABARD. That will be less. That gives very little money, these other avenues. Now that the limits are raised, these banks can perhaps lend more profitably in the priority sector category.
Thank you, Lata, for explaining that so well and beautifully to us. Let's move on and talk about the market's individual sectors. Devang Mehta, Director of Equity Advisory at Spark Private Wealth Management, joining us on the show now. Devang, what are you advising to your clients now? Do you think the worst is behind? It's time to go out there and make all your investments, or stagger it?
Thanks, Rima, for having me on the show. I think, yes, on your channel last time around also, I think the advice was that during such times, right, either you get good prices or you get good valuations or you get sort of good news. So I think the prices and valuations were sort of quite cheap. And I still say that after this huge rally, and I know it is very difficult to probably call it, some people will call it a bounce back, some will call it a relief rally, some will call it a sort of a real rally. So that will only be known in the hindsight, that whether it is a real rally or it's just a relief rally. But I think our control or our controllable is whether positives outweighs negatives. I think probably in the last 15-20 days, the market participants have realized that there are so many, I think, good points that one can note, right from reducing inflation in India, to sort of also industrial production rising. I also had a look at the manufacturing, HSBC manufacturing PMI, which sort of also is again higher than July 2024, the highest number since July 2024, which says that a lot of capex, even private capex, is coming back to the fore, be it Kumbh Mela, be it the wedding season. I think also consumption sort of has picked up rural and on the urban side. My sense is there are larger on the anvil than negatives, plus FII is coming back. Again, I am not making this statement because just seeing the last 4-5 day statement, but ideally I think it is now the selling pressure has sort of with less intensity, and I think there is some buying also which is done by domestic investors as well. So my sense from here on, probably if you have a 2-3 year horizon, the next 2-3 months will present you good opportunities. There will be volatility on the way, considering the April 2nd tariff announcements as well. But ideally, there is less downside, more upside, less risk, more reward.
Absolutely take your point, Devang. Devang, you mentioned a couple of important points. You said that probably the worst is behind. You said that valuations now are a lot more palatable. In that, in that context, which sectors, which stocks are the ones that you're liking? Where are you advising clients to go ahead and add positions?
Vivek, ideally, we've generally been, I can say, very firm in our call that there are themes and there are sectors. I think there is a very easy statement to say that we are bottom up, but certain themes you need to understand, and those themes are, I think, India probably right now. If you talk, the Nifty is around 70% of Nifty is into banks or IT companies or FMCG or for that matter, oil and gas. I think a lot of money is to be made outside of the index, right? There are sunrise sectors. There are a lot of sectors. I think I was just listening to your conversation about priority sector lending, renewables, power automation. There is air compression. There is water management. I think a lot of such themes, which is into lamination, stamping. I think all such micro themes. Semiconductor is another theme which probably one can play by buying a lot of proxy plays rather than the usual capital goods or usual structure type of themes. So I think there are a lot of micro themes which have corrected. Yes, there's this fall in more of mid caps and small caps. A lot of such themes have corrected. I think if there is cash flows, if there is going to be profitability in this companies growing at say 18 to 25%, I think there is no problem buying such themes if you feel India is going to go up the capex curve as well as the consumption is going to improve. I think manufacturing, engineering, this type of companies will also keep on doing well. Even ER&D type of themes will do well.
Understood that. Which are the sectors, especially in the context of the impending tariffs, will you stay away from? Are you right now a little cautious on pharma or some of the export-oriented sectors?
I think, yes, we generally have been more domestic-centric. We clearly know that in India for the next 3 to 5 years, domestic-centric stories or sort of anything that has to do with either domestic cyclicality or domestic even consumption or that, for that matter, even something related to financials will do well. Having said that, yes, to answer your question, there are a lot of themes in the export-oriented. IT would not get impacted much because I think they rely on Indian IT services more often. Pharma, yes, there is a probability that there can be some tariffs. I think some clarity will emerge post the first week of April. But ideally, as I said, we would be more, I think, inclined towards buying domestic-centric stories. I think globally, every week it was changing, every month now it changes, every weekend, every hour the narrative changes. So it's very difficult to take a call on global cyclicals and something which is export-dependent.
Understood that. Now, when it comes to the Indian BFSI space, where does your priority or where does your preference lie? Is it the larger private financials? Is it, the NBFCs? Or would you also look at some of the MFIs? A lot of them have corrected more than 50-60% from the recent peaks.
I think the most interesting part about the BFSI is that, and I always make this a point, out of the 400 lakh crore of market cap in India, there is around 100 lakh crores of BFSI, and there are large banks, there are large NBFCs, but I think the sector which is still extremely small in terms of market cap and also penetration, and there is a rising ultra HNIs, which are sort of coming to the fore, and also there is financialization happening. So I think the proxy to play this is via depositories, the proxy to play this is via wealth management firms, via broking companies, via exchanges. I think this is one theme, even AMCs, which probably will see a lot more penetration happening in India, plus the wealth effect, the rising incomes, I think will also help this type of sort of industry to sort of do very well. So my sense in financials as a BFSI, if I can say, banks would be your usual 12-14% type compounders. But if somebody wants a little bit of more alpha, I think this is the sectors. These are the sectors which I talked about.
Devang, consumption in India was played via the hotels theme. It was played by the premium discretionary spending, food delivery guys over the QSR. So Swiggy, Zomato had a great run. They've corrected now in the last couple of months in this correction that we've seen. But QSRs had taken a complete backseat. Macquarie is now talking about, they've come out with a report, Mangalam was telling us, and how they prefer QSRs over the food delivery guys at the current juncture. Your thoughts on QSR, and is that a consumption play to your mind?
I think so far we have sort of not taken any sort of view on QSRs as such. We've been considering QSRs as well as the likes of the food aggregators. But our model of looking at cash flows, our model looking at free cash flows or operating cash flows, generating incremental ROEs, the business which generate incremental ROEs, and the businesses which grow at sort of abnormally higher rates. If we look at this type of businesses, I think then there are certain hotel companies which have deleverage themselves. We also look at organized retail. I've talked about multiple times. I talked about right? And again, not saying whether not recommending the stock, but I think this type of companies have also corrected. I think there is more money here rather than getting into themes where there is a sort of uncertainty, as well as there is also a sort of whether cash flows will be there or not. So my sense, be in hotels, be in type of aviation, be in the businesses where sort of you're seeing phenomenal growth over the period.
Thank you so much, Devang, for joining us, giving us a view on the markets, your preferred sectors, as well as your views on the entire BFSI pack. Time now for a short break. We'll get back with Prashant Pitti, co-founder of EaseMyTrip, to discuss the company's foray in charter aviation market, as well as much more.
Welcome back. In the red now, and it's now more than 200 points off from the session highs on the Nifty. The Nifty's down close to about 13 points. Sensex down 26 points, so snapping a 6-day winning streak. There was some fatigue which has crept into the markets. The morning was fine the first 1 hour, but since then we've seen profit booking emerging at higher levels. The mid-cap index sell-off is quite steep now. The mid-cap index is down close to about 1.5%, while the small-cap index too is down over 1%, with the advanced decline ratio now standing at about 2 stocks advancing for 7 in the red. The key sectors where we are seeing some amount of profit booking and pressure, they include metals. The Nifty Metal Index is down nearly 1.5%. The oil and gas index, pharma index, realty. These are sectors which did well over the last couple of days in the recovery rally, and today they are retreating. But let's talk about EaseMyTrip. The company has forayed into the charter aviation market. The company has announced a 49% investment in a company called Big Charter Private Limited. Prashant Pitti, co-founder of EaseMyTrip, is now with us on the show. Thank you for joining in. First, if you could tell us, how much are you paying for this 49% stake?
Hi. Firstly, thank you for having me on the show. With respect to the amount and the quantum, that is still to be decided. The board has given us approval to acquire 49% of the stake. We are planning to go ahead with a share swap as a medium to acquire in this company.
Last round, could you give us an indication then? What was the valuation of Big Charter? Some ballpark. I'm sure you don't go into, the board will not give a buy-in, blind. So give us some indication of the amount, the valuation of Big Charter, how much you're willing to invest in it, and what kind of assets, revenues, and margins you would be looking at.
Happy to explain a little bit more about the business. The brand name is basically Fly Big. It has 100 exclusive rights over sectors. 100 sectors, they have exclusive rights where only they can operate. They are pretty much operating in tier 2, tier 3 sectors. These are non-scheduled flights. They have 4 charter airplanes with them. And in the last year, their revenue was 128 crores. EaseMyTrip revenue was somewhere about 600 odd crores. So this is a bigger acquisition done by the company. This will enable EaseMyTrip to basically cater to high net worth individuals, corporate clients, and also people in tier 2, tier 3 geographies who have capability to pay in this high margin business. And to give you some idea, for example, one of the exclusive sectors which they have is from Hildon to Ludhiana. Hildon is basically closer to Noida and eastern part of Delhi. And from Hildon to Ludhiana, only Fly Big can operate under Udan Screen. They have exclusive rights. They have 100 such exclusive rights. And in terms of valuation, it would be a little bit early for me to say. The board and the team is still working on the valuation. And we hope that this will become a very fruitful acquisition for the company.
Prashant, thank you for explaining that. So we understand that the entity that you're looking to acquire a 49% stake in is close to 1/5 of the current size at which you operate at in terms of the top line. What are the margins that they are working on currently? And secondly, assuming all the approvals come in time, when is this particular acquisition expected to consummate?
Well, again, board approval has come in. Now there is a negotiation happening between both the teams, and which is why it is difficult for me to talk about valuation at the moment. However,
no, just the margins of the acquiring business.
So it's a high margin business. Margin can vary anywhere between 10 to 20% business. These are non-scheduled flights. The way Indigo, SpiceJet, Air India operates, this is not the same way. They have 19-seater, 4 aircrafts, all of them are 19-seater, and they operate under Udan scheme, under which government also gives, certain portion of revenues for operating in such sectors, which are not run by traditional airlines. So it's a high margin business, and last year the turnover was 128 odd crores, and we are looking forward to fill more of their demands since EaseMyTrip has about 10 lakh people who visit our website on daily basis, and there's a very, very high demand in tier 2, tier 3 cities. We look forward to ensure that they do not see any empty seats and their occupancy rates are high.
So the company that you're looking to acquire 49% stake had revenues of 120 crore last year with margins of 10 to 20%, correct? What did it grow at last year? Or if you could give us the 3-year revenue growth rates.
I believe the number which I have is for FY22. At that time, the number was about 60 odd crores. From 60 odd crores to about 128 odd crores, the numbers have increased in the couple of years.
And is it a way, what would the capacity utilization be? How much could you scale the revenues up to? And do you have plans to further increase your stake?
So all that is work in progress. It would be very, very difficult for me to, pinpoint and give exact details around it. But yes, we are extremely bullish about this industry. It's an industry which is extremely fast growing and with a very high net margin. It is directly related to EaseMyTrip business as well. As we can basically fulfill their demands even better, and looking forward to grow along with them.
Prashant, just coming back to this particular business, while you have explained the rationale and you've explained the business idea, or the idea behind going ahead with this particular acquisition, number one, why are you doing it outside India? Secondly, why not focus on India itself, given that the market here is quite large? So that is the key question. And secondly, the other question that we constantly get is the absence of any domestic mutual funds as far as the shareholding pattern is concerned. What is being worked on that particular front?
So firstly, Flybig is all India. It's not outside India. They have 100 exclusives within India only. It is not outside India. Yes, we have forayed into opening up markets in Brazil, in Saudi Arabia, in US, and other places. And the rationale behind it is very simple. 3 years ago, we started our operations in the Middle East and Dubai, specifically UAE. And our business has grown exponentially from the Middle East area. I believe it is almost about 5% of our total business, grown organically over the period of 3 years, and it is still growing very, very rapidly. So we want to capture the success which we have received from the UAE area to the other parts of the world, which is why we have sold the seeds in Brazil, in US, and in Saudi Arabia, and a couple of other regions as well. EaseMyTrip is doing phenomenally well in terms of its international expansion, and we would want to continue growth on that side.
Prashant, is this your first foray into charter aviation, or you had tried it earlier as well?
So we have another company called as Nuthana Airways, which is basically based out of GIFT City. But Nuthana Airways, our main focus is basically of buying the charter airways and subleasing it to the others. Their main focus is not to operate. While for this company, their main focus is actually operating the aircrafts under the government's Udan scheme. These are all non-scheduled flights. So this is a very different acquisition in its nature.
Prashant, very quickly, Q4, what has been the trend over there? FY26, what can we anticipate in terms of operational trends?
See, operationally, company, as you would know, that EaseMyTrip is a bootstrap company. Only about last year ago, we raised some capital in the company. Otherwise, the company has grown completely bootstrap, never raised any external capital. So we have been extremely cautious about growing while growing profitably. So in the last couple of years, I believe that we have taken a conservative step of, not putting growth over profitability. The company has continued the profitability streak, and we would like to continue doing so. However, markets right now are well poised for us to continue our growth momentum again. A couple of private players who basically recently forayed into this space again with the newer enthusiasm. They basically burnt a lot of money, and now they are going a little bit quieter. So I believe that for us, the FY26 could look much, much better.
Got that. One final question. Since you're making this acquisition via a share swap, Now, the acquired company's revenues were 120 crore. Last year, you ended with 480 crore. So it's about 1/4 in terms of your size. Give us some indication of the, the valuation of the acquired company, because that will, it's directly going to impact your shareholders who've bought into EaseMyTrip. Your value, your market cap, as we can see right now, is 4,700 crore rupees.
It would be substantially lower than our market cap. Substantially lower than our market cap. Let me put it this way.
Like 1/10? Revenues are 1/4. Would the market cap be commensurate 1/4 of yours, or would it be even lower?
Much lower than that. I mean, we are expecting it to be in the ballpark of 1/10 of whatever market cap is. But again, I would not like to be held on to this. This is the number which we are negotiating with. And we believe that this is going to be a very, great deal for the company. Another reason is that the Flybig people, the current promoters, they also understand the value which EaseMyTrip can bring into the company by bringing lots and lots of new customers which they have not acquired in the past.
Thank you so much, Prashant, for joining us. So an acquisition of a little less than 500 crore is what we are looking at. Well, time now for a short break. We'll get you more on the markets on the other side. Welcome back to Trading Hour. Well, the volatility as far as the markets continues. The Nifty that briefly slipped into the negative territory is now once again just above the flat line, up 18 points. The Bank Nifty to a very similar story, just slightly trading and holding above the flat line. But the broader end of the market is where the selling pressure has intensified. The advance decline ratio has actually worsened. One particular stock that we'd like to highlight is IndusInd Bank. That particular stock is now down almost 5%. Remember, the low that the stock saw after the disclosure that it made in terms of derivatives trading was close to 600. The stock after that saw a significant bounce. But today, the stock, remember, it's also in the F&O band, is now down over 6%, closer to the 640 mark. But with that, it's all the time we have on this edition of Trading Hour. Stay tuned. Halftime Report is up next.